Neeraj Seth, someone who tracks the global macro situation very closely, is now joining us. He's the CIO and head of Asia Pac fixed income at BlackRock and joins us from Singapore. Neeraj, afternoon. Thank you so much for your time. How do you read the data coming out of US? 1 week it's all pessimistic and growth is falling off the cliff, and the next week we are kind of heaving a sigh of relief. Very flip flop on the macro front. How do you or your peers actually are analyzing this data coming in?
Sure. So Ajay, you're absolutely right. I think the markets are trying to react to every single data point, which is normally a challenge. But given the backdrop in terms of the slowing growth in the US, and if you look at the data in the last literally 2 weeks, you had a softer NFP at 114K with unemployment moving up. And then we had a CPI print, which actually came better than expected in my view at 2.9% annualized. So you see the disinflation continuing. That paves the path for the Fed. And then the jobless claims were better than expected. Retail sales was better than expected. So all in all, if I look at it, it's mixed data, which it's telling you that we are in that late cycle of the economic growth. The economy is slowing down, but it's gradual. It's not falling off the cliff. But trying to trade every data point obviously becomes a challenge in this part of the cycle.
Okay, but the commentary from policymakers, do you finally expect rates to start coming in, and the extent of it could be pretty accelerated there in US? And how would the emerging market part of the world read that?
So overall, yes, I think we are now at the cusp of the easing cycle to start in the US. We do expect the Fed to start easing in September, potentially anywhere between 3 or 4 rate cuts in the next 6 months that you can see. And I do think it's an important point because we have been in somewhat restrictive territory for now almost last 18 months. So we are at the point where the rates should start to ease. Now, from the emerging market perspective, I think there are two aspects: the fundamental from a growth standpoint, as well as the room for the central banks to ease. The fundamentals, obviously, they do diverge based on which country you look at. So we can talk in more specific country terms. But the second is more general, which is for the central banks and the emerging markets. To some extent, the door opens for easing as the Fed starts to ease. So there are a number of central banks, more so in Asia, in fact, in the emerging Asia, who would be starting the rate cutting cycle once the Fed starts to cut. So it just opens the door for the central banks, which I do think is a good news for the markets.
How would the FIIs, which have been big sellers in India, they have been mixed in China, emerging market as a whole, how would the flows actually move towards emerging markets when accelerated cuts actually start there in the West, led by US?
So I do think the flows to be positive in the local markets and the local currency fixed income, but they will be selective. It's hard today, given the divergence in the policy, as well as the fundamentals of the markets that you're looking at in the emerging market complex. It's very difficult to actually paint everything with the same brush. And I do think you will see a selectivity among investors when the allocations come across equities and fixed income. So in case of fixed income in Asia, I do expect ongoing inflows in India, potentially higher inflows in markets like Indonesia, to some extent Philippines, Korea for that matter, with the potential easing in front of us. But it's not going to be broad-based as in inflows in every single market.
We're observing the commentary coming in from a lot of global agencies regarding India growth. In fact, there have been some upgrades. And then, even our own central banker, very astute and extremely careful, have been upgrading the growth estimates, which some say is slightly on the optimistic side. What's your own view on India growth? And do you think we can fare much better than, what the naysayers are talking about growth here?
So overall, I do remain positive and optimistic on India growth. But at the same time, when you look under the hood, you do have pockets of weakness. Some parts of the economy are not growing as fast. Now, one good news is that when you think about the CapEx cycle, more specific, the infrastructure bill, which is driven through the fiscal in the country, I think that's continuing. The corporate CapEx hasn't come in as much. The retail or the consumer sector is looking okay. So I do think there is potential for growth to accelerate, but it will require further push from the government standpoint in terms of reforms, job growth, further wage growth, for that to accelerate further from here.
Just in this light, how do Indian equities look? I mean, there are reluctant corrections here, 4-5% at max. Up till now, retail flows are very strong, but when will FIIs come? What are your thoughts here?
So, Ajay, that's a $5 trillion question or more than that, given we have seen a reasonably strong rally over the last few years in case of India outperforming pretty much all other emerging markets. Now, from a historical valuation perspective, if you compare to its own history or to the rest of the markets, Indian equities do look expensive. So rich to maybe on the expensive, depending on which part of the equity market you're looking at, small versus large cap, or the different sectors. But I do think the longer term growth story is extremely strong, and the potential growth will attract more foreign investors over time. In base case scenario, what does happen is, given the strong rally, most of the times investors are looking for better entry points and hence looking for any corrections to actually build further positions. So if you do see any correction, you will see potentially the foreign inflows accelerating in the Indian equity markets.
So that's something to take heart from, that if correction is meaningful enough, a lot of FII flows will start coming in, and they are watching India closely. How do you see, you must be in your part of your research meeting a lot of corporates, listed, unlisted, engaged with, the fixed income side. And what are your thoughts on the health of corporates, on corporate earning outlook, as far as India is concerned in particular?
Overall, very positive. The first part, obviously, when you think about the corporates, it's a combination of obviously the leverage, liquidity, cash flows. Now, when you look at the balance sheets, I would say the corporate balance sheet is in the healthiest point in the last 15 years. Since the 2008 crisis, we saw corporate capex pick up, but we did see the leverage go up in the corporate sector north of 80% 10 years ago, and it has delevered. The whole sector has delevered closer to 50% of GDP in terms of the total debt. Now, I do think that gives room, as the capacity utilization goes up, for the corporates to actually go back on the capex cycle, which obviously further then accelerates the earning potential from here. So we are at an interesting point where we've seen meaningful deleveraging that has happened, but most of that, I would argue, is behind us now. So in some ways, we're probably at the cusp of further capex and earning potential, that cycle to start from here in case of corporates.
That's very interesting. You expect the capex cycle and earnings to actually accelerate from here on as far as India is concerned. Just one last word, because cost of capital is something which impacts both earnings for India Inc., whether it's listed or unlisted, and even valuations as markets are concerned. What are your thoughts on the cost of capital cycle from here on? Will we lag the West as far as rate cut cycle is concerned? When do you see the first one happen here?
So in base case scenario, I do expect RBI to move sometimes toward the end of this year, closer to December. Now, stepping back, if you look at where the inflation is, which obviously the last month data at 3.5% was very, very positive for the central bank in terms of the room. But there was a base effect involved there. So if you take a more medium-term view, the inflation path, the natural rate that the RBI has obviously talked about in their recent MPC minutes, I think there is room for RBI to start cutting, but there's no rush. The economy is in actually a very healthy state, and the inflation is gradually coming down, and specifically the core is very well behaved. The concern remains more around the food price inflation. So I think we will see the rate cut cycle. It's probably not going to be as deep as the developed markets, because India also did not see as much of a hike. We went from 4 to 6.5% on the policy rate. So you can have in the next 12 months 75 to 100 basis points of rate cut. But in addition to that, to your point about the cost of capital, it's the rates plus the risk premia. We've seen the shrinkage in the risk premia too, which certainly helps when you think about the overall cost of debt for the corporate sector.
All right, Neeraj, we'll let you go on that one. Thanks so much for dropping by today on the show.
If you like this video, then like, share and subscribe to ET Now.